Hey, good afternoon, everybody, and welcome to this second of our four-part April educational series. This is all about the combination of price volume. So again, this is part two. We got two more parts coming up later this month. So next Monday, that's April 15th, not only are taxes due, but you'll need to stop in here if you want to learn about divergences. So we're going to do that at 4:30, same time next week, next Monday. And then on April 22nd, we will have our final of this four-part series on trading gaps. So we certainly hope that you're able to attend those two. I think they start getting into areas that are really important and critical for me in terms of my individual trades. Tonight's session on price volume, this is the primary indicator for me. I mean, nothing is more important than what we're going to go over tonight. And I think if you don't have a reasonable handle on price volume, I think you're really up against it in terms of trying to trade successfully. The combination of price volume for me is really at the core of reward to risk and figuring your reward to risk, trying to get stocks near support, trying to either sell them at resistance or maybe if they're longer term holds because we're in a secular bull market, whatever. But the key is trying to minimize risk on your trades. And so price volume is a big part of that. So anyway, again, welcome. Really appreciate you taking time out of your day to stop by. I am going to, we will be recording the session tonight. So for those of you who are interested in maybe going back and looking at the any of the parts of this event, anything that I talk about tonight, you can always go back and look at that. So if you want to keep notes on your own, that's fine, but I'm going to be giving you some annotated charts. I don't have a whole lot of charts. I mean, this is pretty basic stuff. I'm going to try to keep it basic for the most part. And hopefully this will be a nice refresher for many of you. And for those of you who maybe don't understand the concept of price support and price resistance, I think maybe this will be an eye-opener for you. But we're going to go ahead and get started again. Everything's being recorded, so if you have to leave for whatever reason throughout the session, it will be recorded and you'll be able to take a look at that later. So let's go ahead and get this thing started. Let's go ahead and go over the agenda. So there are a few different things that I like to think about when I'm considering price support and resistance. Number one, and this is like technical analysis 101. This is probably one of the first things that you really need to learn about technical analysis, and that is broken resistance becomes support and broken support becomes resistance. And when I say support resistance, I'm talking about price support, price resistance. So anytime either of those are broken, I mean, what you need to think about or visualize in your head is almost like being in an elevator. That's the analogy I like to use. An elevator in a building where when you're on the first floor, you look up and you have the ceiling for the first floor. And if you go into that elevator and you go up to the second floor, then first floor's resistance or ceiling becomes second floor support or floor. And so as you're going up, you're kind of just think about it like you're stair stepping up. As you know, prior resistance fails to hold, we go higher. That then becomes support. And so when you're when you're uptrending, trending, to the upside, that's what you need to be thinking about in terms of trying to find entry points as close to support as you can get them. And most of what we're going to talk about tonight is price support. There are other kinds of support. You have trend line support. You have moving average support. You've got support in patterns, all kinds of different supports. But what we're going to focus on tonight or this afternoon is on price support and price resistance. After we go through a few charts on that, then we're going to talk about how recent lows mark support in uptrends and recent highs mark resistance in downtrends. Very similar concept, but you're not always going back to, if you break down, you're not always going back to that prior support price resistance could be established anywhere. So we're going to talk about some of that. And then the final thing we'll discuss is support resistance differs based on time frames. So if you're a short-term trader, you're probably looking at, maybe a minute, 1 minute chart or a 10-minute chart, maybe an hourly chart. And if you're a long-term investor, you're probably looking more daily charts or even weekly charts, maybe even monthly charts. Well, you can't confuse price and support on short-term charts versus long-term charts. They're completely different. If you're following a long-term monthly chart, you don't care what the support is on a 10-minute chart, or at least you shouldn't. If you are, then you're probably going to drive yourself crazy. And likewise, if you're a day trader and you're looking to make sure you don't lose much capital and you're keeping a really tight stop, it's not going to really do you much good to go look at key support on a monthly chart. So some of it just makes common sense, I think. Anyhow, let's go ahead and start with the broken resistance becoming support, because we're in an uptrend now in the overall stock market. So we see a lot more of this than we do broken support becoming resistance. That's more in a correction or even in a cyclical bear market, or definitely in a secular bear market. But let me go ahead and get this first chart up on your screen. You should see it now. It's Tri-Point Homes, TPH. So again, what I'm going to do, what I'm planning to do is simply provide you maybe 10, 11, 12 charts, talk about support resistance, hopefully get you more and more familiar with it. And then at the end, I'll take your questions. So if you have individual stocks you want me to look at in terms of price support, I don't really want to look at anything other than price support. That's really what this event is all about. So I'm not interested in looking for patterns or looking at patterns or measurements or any of that. I really want to focus this session just on price support and resistance. So what I've done with Tri-Point Homes, clearly we were in an uptrend that began back in October, and you're going to see this on many, many charts. Maybe it's evolved a little bit differently depending on what area of the market you're in, because obviously semiconductors went up a lot faster than other areas of the market. But here with Tri-Point Homes, this is part of the home construction group, which did pretty well at the end of the year. And you can see Tri-Point Homes did exceptionally well. And as it made this break, I mean, I could have added another area of support on here too, because right here was the key resistance level, and then we broke above it. And for the most part, you can see that that's kind of been holding on any of these pullbacks. Other things that we want to bring into account, though, price support is great, but there are going to be other things. There are going to be other corroborating indicators on charts that we're going to want to be aware of as well. For instance, I could look at this chart, and again, I'm not going to talk about gaps. That's going to be something that we talk about more in a couple weeks. But I mean, you've got some pretty good gap support right here. We came down, we held that. So anytime you're kind of in this zone, you got this price support area. You can see a nice hammer printed on this support level right there. You had a nice reversal. We were below intraday, came back up, finished all the way back above the 50-day moving average there. Here, if you remember our talk last week on candlesticks, that is a piercing candle where we go just below this support level, but then we gap down, we come back up, and finishing in the top 1/2 of the prior day's candle body. That's a piercing, reversing candle. So it's a combination of these things that we need to be looking at. But the key is when you have resistance and you break above it, then that should become pretty good support on the way back down. Now here, if you can see at the top, after we broke out above the July high, look at how many tops we put in just above the 36 level, maybe around 36.20 or so. We went up here, got to 36.20, came back to the breakout level right here, and also the rising 20-day moving average, which is something we also need to be aware of. Went back up a little bit, came back down, printed a hammer. Now you might say, well, yeah, but this one finished below the 20-day moving average. True. What's the most important indicator in the market? Price support, price resistance, and the volume that goes along with it. Here we had just talked about this is key price support. Here it held at the 20-day. Here we went below the 20, but we still held it. Here we had two rough candles, went right back down to it again and bounced. Here we came down and tested it. Here we tested the low. Here was a nice reversal off of the low. Here was a bounce off of the low. And then when we finally broke a little bit below, you can see the next day we printed a reversing candle again. So this combination of these two candlesticks forming a bottom right at this support level. So I think it's pretty clear that here is your resistance level. The more points that test a support level or a resistance level, the more significant they become when they get broken. So in this case, if I go up here and I pull back and then I just go right through, that does still leave support. But in my opinion, it's going to be much, much more significant support if we've gone up multiple times and have not been able to get above it. And then we finally get above it, like we did on TPH. So here we get through the 3620 level. We go all the way to 39. And then we came back and it looked like maybe we got to about 3640. But notice as we pulled back, now that rising 20-day moving average comes in right at price support. So again, we're getting corroboration. We're getting more than one signal that this stock should bounce from that 36 and change level, which so far it has. Now, longer term, I mean, if I'm a short-term trader and I was in this and I was just kind of riding it, I mean, once you establish support and resistance, you could trade it multiple times in this range until it finally breaks. But now that it's broken, I would expect that 36 level to hold. If it doesn't, then you go down to your prior support level, which would be down, again, just below that 34 level. So this is kind of giving you that, here we're going up on the elevator, we get through the second floor, and we get off, and now that becomes support. It was resistance before, now it's support, now it's our floor. And so we're just walking around on the second story until we get back in the elevator and we go through the ceiling, and now we get back out. Now 36 and change becomes our floor. Used to be our resistance. That's how you get this change of going from broken resistance becoming support. I got another example for you. This one isn't probably as clear, but I'm looking at Applied Materials here. This was a situation where we went through resistance right here, came back down, maybe went a little bit below price support. Once we go through resistance, remember, it becomes support. Here we come down, we test it, bounce. Here we come down a little bit below, but now we're testing the 20-day moving average. When you get price support and the 20-day both in the same neighborhood, personally, the way I look at it is the lowest of the two becomes the key support. In this case, we bounced off the 20, went back up, and now look what we did. We break out in February above the January high. Now that ceiling becomes our floor. 2 days later, we go right down to it, test it, and back up again. That's why, you have a lot of traders that are looking to get in on breakouts, which is great. And if I can catch it right on the breakout, many times I will do that as well. But a lot of times when you do miss the breakout, you can see here we went from 177 up to 188 in just a day, just 1 day after the breakout. If the problem is if you chase and the next day we're back down to 177, now you're down $10, $11, $12 on your trade, and just as you're hitting support. Doesn't it make more sense that your reward to risk is so much stronger if you get in on a pullback to test support at 177? I mean, that makes a lot more sense to me. And as a trader, I mean, call me crazy, but I'd rather buy at 177 than 187. So a lot of times it just comes down to patience and discipline, seeing it on the chart and then waiting for your moment to pounce. Again, when you see a breakout like this, set an alert at stock charts. I mean, if you're like me, I don't set alerts often enough, and I end up missing trades from time to time because I don't use that feature. That is a great feature at stock charts. And you don't even have to place it at 177. You could simply just place it maybe at 179, just so that you know you're getting close. And then perhaps watch it, or maybe you buy it at 179. 179 is better than 187. Maybe it's not quite as good as 177, but it's pretty darn close. The idea is you want to be buying the stock, in my opinion, as it pulls back to that prior resistance level, which is now support. Now, when I look at Applied Materials at the current chart, I'm looking at it and seeing more support now, probably at about that 197 level. Why? Well, on this gap down, we pulled back. That was a support level. And after going down for a couple of days, we gapped back above. But look at how many lows we have established at 197. Now, this is where, supply and demand come into play. So if you've got a stock that is hitting the same price support level, even though maybe it's not broken, resistance becomes support. It's not this support level. And we'll talk about this more a little bit later. But just pulling back during an uptrend to a level where you continue to bounce off of, that establishes support. Who's buying? Somebody's buying here. You've got buyers jumping in at 197. Why that level? I don't know. But they're jumping in at 197, and they've done it multiple times. Now, if we were to go back down to 197 again, not only do we have all of these support levels, but look at the 50-day moving average creeping up underneath that. So again, you're getting corroborating information on Applied Materials. Now, maybe Applied Materials never comes back to 197. It could just break out and take off, and then we'll have new support probably at around 214. But right now, it's been going sideways. It hasn't broken out. And there's still a chance, especially if semiconductors weaken for a period of time, there's a chance Applied Materials comes back down, tests this support level and the 50-day moving average. All right, now let's go in the other direction. Let's look at broken support becoming resistance. Now, again, most stocks are trending higher because the stock market's been going up and we've been in an uptrend. So this is going to apply much more often when you're in a correction or when you're in a cyclical or secular bear market. These are going to be rules that you want to live by. The problem with this is I'm not shorting in a secular bull market. And what this requires when you're downtrending is to consider thinking about shorting when you hit major resistance. Because what you're expecting is for it to roll back over and go down. So you're doing the opposite. You're selling first at a high price, and then you're looking to buy it back later at a lower price. It's the exact opposite of what you do during uptrends. Uptrends, you're trying to buy it at a cheap price and sell it at a higher price. Here, it's the reverse. You sell first. If you're not familiar with shorting, all you're doing basically is borrowing shares. And you're not physically borrowing, but your broker is going into someone else's account, borrowing shares that they own, and you have to cover at some point or buy to return those shares to the rightful owner. So you don't even own the shares. I mean, when you're shorting, you effectively are borrowing and selling borrowed shares. And then you've got to buy them back to return them to the person you borrowed them from. That's the way shorting works. Anyhow, you can see here, we had this bottom on Nike. It was downtrending. It bottomed here at the beginning of June 2023. Came back down, got very close to testing it. So kind of like this double bottom. Went back up, couldn't really get through the prior highs. We rolled over, and look, we had a breakdown. So we broke down, volume picked up. Guess where we went on the recovery? Right up to the prior support level, which now becomes resistance. Hit that, and the falling 20-day moving average. Hit both of them. Failed and went right back down. Now, coming back over here a little bit later, on this big move down, you can see that was the heaviest volume of the year on this gap down. We went sideways for a while, could not get back through the 50-day, and then broke down beneath these initial lows. And when we broke down, it was around 107, 106.50, went back down. Ultimately, when we did come back up, we ended up failing right where we broke down. Broken support right here, even though it was short-term support. We broke down and eventually came back up, tested it, and this time we've got the 50-day moving average kind of boxing us in, not allowing us to make that move to the upside. Then you come down, you break below this short-term low right here. You go back up. What do? You test the 50-day moving average and that prior price support level before you roll over again. So clearly we have a downtrending chart with Nike, and that means that, shorting is going to be the better way to try to make money in a stock that is downtrending. Now, Nike did come all the way down here and hit what? Support. This is long-term or more intermediate-term support, but you can see off of the last time we went down to about 88, where did we go after that? To 123. Now we work all our way all the way back down to the 88 again. Now we're at support. Now, I don't normally like to buy into stocks that are at, that are in as part of a downtrend, but this is a key level. If you're going to buy a stock at any point in a downtrend, the best time to get it is when it hits a major support level going back several months or even a couple years. In this case, you can see Nike hitting major support here, and it did bounce today. Now, does it continue to bounce? I don't know. But if you get in here and it breaks down below 88, you get out quickly. You manage your risk. A lot of folks are just seeing, you're out here in the middle of a chart, it's in a downtrend, and they think, well, Nike's a good company, I'm just going to jump in. And before you know it, you're down 10 or 15% because you're buying it in a downtrend. You're not buying it at a major support level. And so you end up losing a lot of money initially that you don't really need to lose. So Nike now has hit more intermediate term support, but it's still in a downtrend. That's why you have to respect this support level. If it doesn't hold, you don't want to try to be a hero. Let it go. Another chart similar to Nike would be something like McDonald's. Now, McDonald's been more sideways over the course of last year, but it certainly looks like to me with the volume from the second week of March, we went down, we took out this low, bounced. We haven't been able to get through the 20-day moving average. And now after setting these two lows along with this gap support right here, we bounced. And what happened? Look at the volume pickup as we lost this level. So that was our prior short-term support. Now, if McDonald's bounces, where do you think it might fail? In my opinion, if it gains $8, $10, gets up to this price resistance area and or this falling 20-day moving average, that's where I would expect McDonald's to fail. So if you like to short, I like shorting on McDonald's around 277. I won't do it because that's not part of my strategy. I will not short a secular bull market. I don't care if the chart is weak. Why spend my time trying to find the 20% of charts that are weak when I have 80% strong that I can pick from and trade in the direction of the trend? So for me, I don't short, but it's not like I don't recognize weak stocks. It's just not my strategy. If you like to short, I think if McDonald's were to get back up to about 277, you're going to be able to manage risk on a short trade at that level pretty darn well. You break above the 20-day, you could just let it go. Take what, 1% loss or less? It's not about being right all the time. It's about managing risk. If you want to be a good trader, a successful trader, you have to successfully manage risk. Price support and resistance is going to give you the best opportunity to manage your risk. Other things, the moving averages, trend lines, all of that's great. Gap resistance, gap support. These are all, reversing candles. All these things are great. But a lot of times when you make that move back up and you fail, sometimes you'll see a shooting star or something. You'll see a move where it looks like we're breaking above intraday and we come back down and close below. That's usually a great time to pounce from a short perspective. All right. How about recent lows marking support during uptrends? So here you can see CELH, Celsius was clearly uptrending. Here we pull back, we go back. We've got gap support here. We've got some recent price support there. But really, this bottom line, what I'm connecting here is this gap support from back in the second week of August. And then this top support line right here is these lows as we come down. You can see multiple lows coming down in about the 49 to 50 area, maybe even into the 48s. See all these green arrows? And then we come down one more time. Look at the failure to get above 60. So we're kind of trapped in this range, but the prior trend was up. This isn't necessarily the major support level, from breaking out. Like I would be maybe looking at the highs coming across here, which would have been around 52. Maybe this breakout right here, which would be around 45. Instead, what I'm basically drawing here are all of these recent lows along with this gap support. They all tie in together. I mean, you can see here we came down, put in like a little bit of a hammer there. We touched the line here, touched the line. Bullish engulfing candle right there. Reversed back up for a day, came back down, printed a little hammer, reversed back up for 2 days, came back down, and then finally made the move all the way back up to 60, came down one more time to 49, and then we break out. Now, we break out at 61, we go up to 65. What do? We come back and we test 61 before we break out again. And even on this chart, look at this. If we pull back, we hold 85. We go to a higher high, pull back, hold 85. Go back up to 95, come down. What happens? We fail to hold 85. We come down, and now we're trying to get back through 85. Unsuccessful so far. Now, this is not a downtrending stock. This is not a position I would short. This is not a downtrending. You're going back up, testing resistance. This is an uptrending, and it's more like you're coming down to try and test support. So I am not shorting an uptrending stock in a secular bull market. That's even worse, in my opinion, way worse than shorting a weak stock. All right, another stock, similar. This time, the recent low on this gap up, you can see, and this is earnings related. I'll talk much more about these gaps in a couple of weeks when I talk about trading gaps. But just to kind of give you a little bit of some of the thunder ahead of time. When you gap up like this and you keep moving up on very strong volume, that gap support where you opened kind of becomes your recent low. Look at what happens afterwards. We end up going up, taking out this high, moving to a new high, and now when we come back down, we're testing the top of gap support, which is the recent low. And in this case, we're right on the 20-day moving average. So DIX, in my opinion, is a great trade right here on the long side. I mean, if it goes down below the 20-day, you can get out pretty quickly. Or if you happen to like the stock, but you're like, well, let me get half a position. If it goes down and fills the gap, I'll get the other half. That would get me averaged in around 198, which I would love. Maybe that's your strategy. Fine, get into half. I mean, everybody's got a different strategy. But the point here is that after this big gap up on this kind of volume, your buyers were in at about 208. That's where the buying was. So you go back down there, everybody was buying on heavy volume at 208 before. Shouldn't I be expecting that they're going to buy at 208 again? Well, 207.55. Let me see where that opening gap was. 207.83 was the opening gap. This low was 207.50. And today we got down, closed at 207.55 with a low actually at 206 and change. You could even put a stop into that 206.63 level, which is less than a half of 1%. I'd be looking for a bounce here. I mean, maybe we go down intraday and, get, our stop gets triggered and then it comes right back up again. That's always a possibility. But this is a key area of support. The stock was just up at 225, 226, 225.79. Now it's at 207.55. It's down $18 from its high. That is pretty close. That's probably about 8% off of that high. That's a nice pullback for a trader and right at support. That's what we look for. That's what we're trying to do. Get stocks at support to help us manage risk if we're wrong. If we're right, we're going to make $18 back to the high. If we're wrong, depends on where you set your stop, but I would hope not to lose more than a buck or two. A buck or two versus 18. Well, if it's a buck to the downside, that's an 18-to-1 reward to risk ratio. That means if you set up all your trades like this, you'd only have to hit 1 out of 18 to break even. You could go 1 in 17 and be even in terms of your portfolio. Now, you don't get 18-to-1 odds on trades very often. But even if you give it $2 to the downside, 18 to the upside, that's 9-to-1. Anyway, let's keep moving here. One more of these recent lows marking support. This is Alpine Immune Sciences. So this is a biotech. It's very aggressive. These are types of companies that can gap up or down without a whole lot of notice. So I would not even be in ALPN unless I was comfortable with taking the risk. And I probably would have a smaller position size than normal because of the additional risk. I mean, this stock topped at 43 3 weeks ago, 2.5 weeks ago. And today it was down as low as 34 and change, 34 and a quarter. That's $9. That's more than a 20% drop from its recent high. And you might say, well, yeah, how do you know that's going to happen? Well, here's a negative divergence. Higher prices, lower PPO. What does that tell me? I'm normally looking for a PPO centerline test and or a 50-day test. That's what I look for with negative divergences. So, and again, I'm not going to steal thunder from next week's presentation, which is all about divergences. But here you can see how a divergence, sending it back to the 50-day, also happens to send it back to a key price support level. So remember, I'm talking about corroborating price support with other signals. Negative divergence tells me look for the 50-day. That's exactly where I went today, basically almost right to the 50-day before reversing. If you'd gotten in on this stock today at price support and near the 50-day moving average, you would have essentially made 10% in a day. And I see it all the time off of price support. So here's an example of recent price lows. This wasn't any major triple top breakout. We were just going up, up, up. Really didn't have any major support since this big breakout all the way down here around $20, $21. The rest of this is maybe that's a little bit of a breakout there around 28. But for the most part, we just keep going higher and higher. So these pullbacks, when you get multiple pullbacks that all go back to the same price level around 34 and a quarter or so, and then you get a negative divergence that sends it right back down to the 50-day, which is right at that level again. I've got at least 5. Actually, I could have put another arrow in right there. That would have been a 6th test of this support line. Moving on. How about recent highs marking resistance during downtrends? So here, MAA, I think this is a real estate company, trending down, reacts back to the upside. Maybe the downtrend is over. We don't know. Had a pretty good move. Pulled back. Pretty good Move back up again. Can't get through this resistance. Pull back. Where did we break down from? See the support that we created right here at about 130? Guess what? When we go down to 122, put in a hammer, and this was a low, broken down, resistance, multiple tests. We break out. What does that mean? Now it's support on the way back down. We had a hammer right here at support. We go back up. Where do we fail? We fail right where that prior support was. It's now resistance. We go back down. Now at this point, we don't know if this stock is going up or back down. I don't know if it's going to break this support area, head back to 115, or if we're going to move back up and maybe ultimately break out above 137. We're still in the middle. Hasn't told us yet. But what I do know is that major resistance is at about 137, and pretty darn significant support is down around 122, 122.50, maybe even 123. Let's see which way it breaks. But you can kind of follow along all of the different support resistance levels. I also pointed this one out. When we went down, we broke below all these prior lows. We established a low, bounced for a couple days, came back down, double bottom, bounced again, and then broke down. Once we set a bottom here and we started moving up, where did we fail? At that prior breakdown. So again, this chart is showing us broken support becoming resistance, and it's also showing us recent highs marking resistance during an overall downtrend. Now, if we can break back up above 137, we have a higher high, a higher low, and then we'd have a higher high. It would start to look like it's kind of converted from a downtrend to an uptrend at that point. But we still got some work to do to get there. All right, another one downtrending. How about Estee Lauder? So it's downtrending here. We kind of make a gap up and we break out, but is it going to hold? Is this downtrend completely over? I don't know. I mean, here was a rebound, so I kind of look at that as resistance. And then for the most part, we just went down from there. So it almost seems like that area right there needs to be cleared. But now that we've gapped up to the 158 area, pulled back, went back up again to about 158, pulled back. Where do we pull back to? The recent low. We're in this trading range again. Which way are we going to break? If we break above 160, this resistance then becomes support. If we break below 140, then this support becomes resistance. All right, last thing I want to talk about, and then I'll take your questions. Support and resistance in different time frames. I'm going to show you the same stock in 3 different time frames. So first, I've got Trip.com on an hourly chart. So this is just going back the last month or so. Each one of these candlesticks is an hour. Now, I looked at this. Here's a gap, big gap up. So that's a gap support. We come back down and we test this area without breaking down, and we start moving back up, nearly get to the recent highs, and now we're just kind of trading in this range. So I would probably say, looking at it on an hourly basis, especially now with the 50-hour moving above this, I would say 48 is a pretty darn big support level on Trip.com on an hourly chart. So remember that number, 47.60. Now, if we move on and we take a look at the next chart, which is a daily chart, we have a whole different ballgame. In fact, what I would say on this daily chart, I mean, maybe we would say that the newest, most recent support level is going to be around 47.50. I'm fine using that level as a short-term support area, but if you do use that and you get stopped out, you may get stopped out before you even test the 20-day moving average. And the 20-day moving average has been holding its support for the last 2 or 3 months. So do you really want to get stopped out on price when you've got the 20-day coming up? I would rather wait, and maybe at some point this 20-day gets above 47, and then you've got the combination of the 20-day and price support. But until then, I mean, on this daily chart, I see a major high marked by that shooting star candle all the way back in mid-August. And if you noticed, we came all the way back up right to this 42 level before we gapped up and traded higher on increasing volume. Where did we pull back to? 42, after going all the way up to 47 and a half. So if you're impatient, you chase, you watch it go all the way back down to the breakout level. If you're patient and disciplined, you're ready to commit your capital at support. And from 42, if you're fortunate enough to get in there, and it was also basically a 20-day test, if you're fortunate enough to get in there, here in a little over a month, you've gone from 42 up near 49. That's $7. That's about a 17% move in about 5 weeks. And once again, you could have set your stop very tight. And listen, I know this is hindsight. That's what technical analysis is. I mean, basically, you're looking at prior action and you're trying to predict future action. I mean, that's essentially what technical analysis is all about. I learn more from studying prior charts than I do from looking right now at today's chart, looking at this. I've gotten a lot of experience by going back and looking at charts. And it doesn't mean that this 42 level is going to hold. Don't treat this as though it's a guarantee. What 42 represents is the best reward to risk entry point. Doesn't provide a guarantee. But if you chase this and get in at 47, how bad are you going to feel if it breaks below 42? Let's say it goes down to 41 intraday. Now you're down $6. If you bought at 42 and it goes to 41, you're down $1. It's going to be a little bit less emotional. And you don't want to get into a situation where you're always trading on emotion. You're upset, you're panicking out. Once you get to that point, market makers have you. You don't want to be in that position where you're already down considerable amount before you ever even get to support. All right, so this is a daily. What about if we moved on to a weekly chart? I mean, here I kind of showed there was a lot of resistance right in here, about 29 to 31. We broke above. You can see the volume really pick up in here as we broke above. We get up to about the 40 to 43, 44 area, which also was the top over here and here and here. So you can kind of see 40 to 44 acts as pretty good resistance. And then 29 to 31 acts as pretty good support. But notice the volume pick up as we went through 44. And as we pull back into this zone, and now we break out again. So there's a couple of different levels I could look at here on the monthly chart. Probably the one that I think is most important, though, is 42. That was the recent low where we went right down to 42, just below maybe. And look at the 20-month EMA sitting right at about 42, 41.71. So I'm looking at a long-term weekly chart thinking that probably 43 to 44 would be really good support. If I go back to the daily chart, I'm thinking probably 42 is the best support level and maybe a little over 47 short term. I mean, if we get, especially if that 20-day keeps coming up underneath. And then if I go to an hourly chart, it's 48. So I've got all kinds of different support levels depending on which chart I look at. So if you're a day trader, you probably want to focus on the short term. If you're more of a long-term investor, you'd be focusing more, in my opinion, on a monthly chart or a weekly chart, something longer term. And I think I may have said 20-month on that weekly chart, 20-month moving average, but it's really a 20-week. That's the 20-week moving average. I don't know what I said, but if I said monthly, I meant weekly. All right, and that's basically what I wanted to go over today. I just wanted to illustrate the basics of support and resistance because, in my opinion, that's where you're going to find your best trades. And the ones that corroborate other signals, like that 20 period moving average, like the negative divergence, where I'm looking for a 50-day test anyway because of that. And then you go down, you hit the 50-day, and you're also hitting key price support. That gives you multiple reasons to be thinking about getting into a stock. And so for me, that's kind of the critical part. So, John, I don't know if you're around, if you can go over some questions with me.
Yeah, just before we do, I want to remind, and we've got quite a few questions, but just to remind people, this is a four-part series. These first two have been open to the public, meaning you didn't have to have any type of membership in Earnings Beats. The next two, where there's going to be a lot of meat that Tom gets into, you have to be a member, and that includes people on the trial. So if you're not currently a member and you want to get in the next two, just sign up for a trial membership prior to next week, and you'll be included. So I just wanted to make that point. All right. Questions. Would you agree that the piercing candle on very high volume on TPH is the most important candle on that whole chart?
Looking right here. Well, I don't know what happened on that day. I'm not sure if that was some kind of an offering or if that had to do with earnings. Um, it looks like 3 months here. Actually, that's option expiration day, quarterly. And you can see that tends to be the highest volume days on this stock. So I would say it probably has more to do with options than anything else. I mean, that's weird though, because I don't think of this stock as one that would be heavily traded in options. So I'd have to go back and look. But yeah, I mean, just if everything else is equal, yes, when you get a reversing candle at support with big volume, that would be probably the most significant candle on this chart. I would agree.
Okay. For this is a good question. For long trades, how do we scan for stocks at support?
That's a really good question because support is subjective. It's not objective. It's not like the 20-day moving average where it's always exactly, wherever that line goes, you do the math. So I don't know of any way you can scan for it. We keep our chart lists. For instance, I have a strong earnings chart list. I have raised guidance. I have strong accumulation distribution chart list. We've got short squeeze chart list. We got seasonality chart list. And a lot of those chart lists I do annotate. I spend a lot of time in our service annotating charts. And I don't know if members really get the best use of that. But if you quickly go through and look at the charts on those chart lists, you should be able to quickly see if any stocks are hitting key support levels that I've annotated in the past. Just remember that when I annotate these charts, another 2 months could go by since I had first put them on the strong earnings chart list and annotated them. So we might see certain support levels hold. We might see other ones established that are not annotated, but it gives you a really good idea of where I'm looking at support. I mean, I literally, when I do these annotations on the strong earnings chart list, I probably spend no more than 10 seconds putting the support level in, or maybe the two support levels in, because a lot of times I do two different support levels. And I'm just looking, and it's just from experience, but just quickly identifying what I see as major support. Like on TPH, clearly I just see all of these tops, and we go through it. To me, that's major support. But if I was going to put a second one in, like I did earlier, because I think I annotated this one, but I mean, look at all these, there, or maybe I would keep it at at that gap support. It would probably be one of those two levels. I'm guessing I'd probably do it right around there,
All right.
just because there's so many tests of that line.
Okay, how much room, if any, do you give broken support at the end of the day?
That's another great question. I mean, when I use support, and I didn't even mention it, but I like to use candle bodies, which are opens and closes. I normally, if I'm looking at all these tops, I'm generally looking for the highest candle body. And that's where I'm putting the resistance line. So if we get a breakout, I mean, here we got a breakout. It wasn't by much, but it turned out to be, what ignited the stock to move up another 10% over the next week or so. Um, it comes down to an individual choice. And I think a lot of times the amount of room I give it to the downside is a lot of times based on where I got in, which is why getting in at support is so important. Because if you get in at support and then you break slightly below, like we did here, maybe with this gap down, it gives you at least, time to consider whether or not you want to take, just exit. I mean, that's probably the most disciplined approach. Is that, yeah, if you get an exact candle body and you know where that support level is, if you open or close below that support level, normally that would be, it's probably a smart idea. It takes all the guessing out of it just to exit.
Okay.
Um, because I do watch the action so closely during the day, um, I would, I tend to kind of see what is going on. Like, for instance, this stock that gapped lower, if it's just slightly below support, it's in an uptrend, and let's say it has a strong AD line, that weakness in the morning, a lot of times is an opportunity to get into a stock that has a strong AD. So there are other factors that I would consider. But if we're just talking about price support and wanting to keep it simple and wanting to remain diverse or disciplined, then I would say if you go below that level, even if it's a penny, you should be able to mark support and look at use that inspector button to go in here and say, okay, this open was 33.23. Here we opened at 33.36, which was 13 cents above that support area. Or if you're using this candle, 32.64 was the open. Whatever it is, if I get a close below that area, the disciplined thing to do is to sell it.
Okay. AMAT, green arrow, buy. What would your reward to risk be at that point?
AMAT,
Yep.
right here, I'm assuming that arrow. I mean, you're getting in at 177. You're playing this as an uptrend. Remember, in a secular bull market, it depends what kind of trader you are. But if you're able to get in right at 177, if I'm a day trader or a very, very short term trader, I mean, the next day I hit 185, 186. I mean, I'd be out. I mean, that's $10 in a day. If you're a short term trader, that's a nice profit, 6% in a day. So I'd be out. But if you're somebody looking at this candle and saying, wait, we got a big volume breakout above this level, we're in an uptrend, I love the semis, I'm going to hold it as long as support holds. Or maybe you're going to give it the rising 20-day moving average. Maybe you get out of it right here when it closes just slightly below. Or maybe at this point, you keep raising your stop. I know there's some people that like to advocate, 5% stop or 8% stop. I don't like using random percentages because those random percentages from here, if I had done a 5%, it might have taken me out at 179 before I even hit support. So I don't like those random percentages. What I would do is raise my stop to this level. And if I break out, then essentially I'm raising my stop to the next level of the breakout, which would be around 185, 186. You break out, you come back down, you test that level, and then you go up here and you break out again.
Mm-hmm.
And so then you've got the recent support. So now my stop might be 197. And I'm hoping it breaks out again. If it breaks out, guess what? My stop then moves up to about 214. That's the way I would play trailing stops. I don't like percentages because sometimes the percentages get you stopped out right before a key support level. And I don't want that to happen.
All right. How long do you wait for a stock to break out of a sideways move?
That's a good question too, because sometimes they can just sit there and sit there and sit there. It was one of the stocks that I had earlier. Let me see if I can find it. Was it was it TCOM? Was it? No. Um, I think it was one of these recent lows. Yeah, right here. I mean, look at this sideways consolidation. There's no way I would have held that long. I mean, I can see the support, and you might have it on a watch list. You might want to buy it when it hits support, but I'd probably, after hitting it multiple times, I'd probably be taking profits. I mean, even if you get it at 49 here and it goes up to 53, 55, I mean, you're talking about almost 10% in just a couple of days. As a trader, those are great profits. So, yeah, I up and down like a yo-yo is not only not making me money, but it's costing me that capital from being invested somewhere else. So yeah, I don't like to sit in a range for a long time. I mean, how much is too long? It probably depends on the chart, the stock, how fast it went up. I mean, sometimes when stocks go up, they tend to take a little while to consolidate. Now,
Mhm.
this right here was just way too much, though. I don't know. It really would vary by stock. I don't think there's a one size fits all answer.
All right, you want to try to do a price volume analysis on Tesla?
Sure. I've actually already done it in my head. So this wouldn't be too much problem. Short term, what I would be looking at is this double bottom. So right here, we went down, we established this bottom. I mean, if you look at this right about there, or maybe even right about there, the only candle, on the way down, the only candle was this hollow bullish engulfing candle that formed right at this key support area. And we bounced off of it. You can see gap resistance right there. Didn't really talk about gaps that much today, but essentially that's your gap resistance. We filled the gap. We came back down. We broke down on pretty good volume below this support level at 180. Came back up a couple days later, failed at 180, went down and set a new low. As far as I'm concerned, right now, Tesla is in this trading range 161, 162, up to maybe about 182. 50-day moving average. I mean, I know it looks good today, and I'm a fan of Tesla, but if it got back up to 182, I'd take my money.
Okay.
I'd like to see that breakout above that 50-day and above this price resistance because we could simply turn from 182 and go right back down to 162, at which point we might break down or maybe it holds.
Hmm.
Remember, this is a downtrending stock. It's not typical of what most stocks look like right now. You have to respect this downtrend until Tesla starts to show signs that it's broken out of it.
And we'll get a couple more in here. I imagine this is maybe a stock charts tool. Do you ever use the volume by price overlay?
I don't usually. Um, I I'm not going to say anything bad about it. I mean, I certainly think that there's a lot of merit to it, just common sense. But let me see if you go down here, I think it's under the overlays volume by price. So essentially, what it does is it overlays any volume that where you got to close within this area, any volume, any close in this area for each one of these horizontal bars coming out, it's telling you up and down volume going across. But you could see that the biggest volume occurs between 240 and 260. So in theory, Tesla, if you were to get into an uptrend and get back up into that 240, 260 range, what this is telling you is that you're probably going to run into a lot of resistance because this is when we have seen a lot of selling, a lot of buying as well. But this is kind of the pivot area on the chart for Tesla going back over the last year or so. Now, if we stepped it out and we looked at 3 years, then these different ranges will change. So if you're a day trader and you're looking at a 3-year chart to see where support is, I would scratch my head and ask you why you're doing that. Because you probably should be maybe looking at a 1 month hourly with this bar. And then it'll tell you a little bit more about the short term. And you can see Tesla right now. This is the area over the last month where we have had the most volume. So this would be an area where maybe we would see us roll over again, since we're coming up from underneath. Getting back through this area using the volume by price would be a bullish signal.
Okay. All right,
But
let's wrap up so we can keep this within an hour.
yeah.
And if we missed your question, it's really urgent to you, you can always write to support at earnings beats. We'll try to get to it. But this is a good one to end on. Can you analyze QQQ at this point and look at support and resistance?
All right. Well, this is kind of what I do almost every day. So I think there are a couple things. Probably after this gap up, you can kind of see a couple of tests of the QQQ right here. With this gap up, the low that day, well, I'll look at it in a minute. I need the inspect button. But that low looks like it connects this close to being that low, this low, this low. And so even if we were to fall a little bit below the 50-day moving average, I would still be looking at this as your short-term support, which looks like it comes in around 433 or so. So let me get out of here and then we'll look at those candles using the inspector button. The low there, 433.14, 433.73, 433.08, 433.35. Oh, that's the close. I think I've been doing all the closes. Intraday there's 432. Intraday there was 433.08, 433.73. Actually, maybe I was doing the intraday, except for this other one over here. But 432.17 kind of was the low. I would be watching that level. I mean, I think so. We have a couple percent down to that. And then you just stair step. I mean, if you go below that level, obviously gap support would come into play here. We closed that day at 425. So if we lose 432, I don't really see any major support till we get down to 425. You lose 425. If I was looking at the standard broken resistance becomes support, then I would annotate, and the line I would draw would be right here. Because this is really the last time we broke out and we haven't tested a support level. So, I mean, if things really got bad, and this would be kind of like a worst case scenario for me, I don't see it going down this much, at least not right now. I think maybe later this summer, we could run into some troubles for the QQQ and the spider. I just don't think, and right now I'm not seeing that kind of a drop. But that would be the support level, maybe longer term. And probably, I don't know if we used, probably need a little bit longer chart, but if I'm just looking at this low and this low, yeah, that's not coming up. I don't know if there was another low down here that was lower that might turn this, looking something like that, where we come up here and, where this trend line then would become, would be somewhat close to this major, what I would call maybe intermediate term support down around 413, 414. I'd have to go a little bit further out to look at that. But right now, what I would be concentrating on would be that move, any kind of a move down to about that 432 level, right about there. So that's what I would say on the QQQ right now. All right, so I guess that is it. Really appreciate you coming in, tuning into this. We did wrap up in an hour, which was good. We have two more events coming up next Monday, April 15th. I'll look at divergences. That is a really important event because divergences do give you targets to look for, as I pointed out in one of the charts earlier. And then finally on April 22nd, it'll be the fourth of our four-part series, Trading Gaps. And I would say that somewhere in the 60 to 80% range, or maybe even higher, my trades have something to do with earnings gaps. I like to trade earnings gaps, or at least stocks that have shown solid earnings gaps to the upside. Maybe I buy them at a support level. Maybe it's not at gap support, but those are the types of stocks that I really want to concentrate on. And so that event will concentrate on trading gaps. And I have a few strategies that have worked for me quite well over the years, and I'll be sharing some of those on the 22nd. So like John mentioned, if you're not already a trial member, you can become a trial member at any point and be able to attend the next two members only events. So this is a 4-part series. There, it's free, but the first two was free to everyone, the public included. These last two will be free, but they'll only be free to our free trial members of our service. So anyway, thanks again for stopping by. Hopefully you learned some things from this event, and use that price support and resistance to better manage your risk. That's really what it's all about. Have a great evening, everybody. Happy trading.